Your retirement plan is built on advice invented by people who wanted your money, not your future. Every rule you follow, every number you trust, most of it is wrong. Let's fix that. 1. Everyone says $1 million is the finish line. Hit 7 figures, retire in comfort, sleep soundly forever, and consider the problem solved. This is a spectacularly comfortable lie, and it costs people their financial security in slow motion. $1 million is not a universal retirement number. For millions of Americans, it will run out embarrassingly fast, not because they're reckless, but because the math was always wrong for their actual situation. The 4% withdrawal rule, the calculation behind the $1 million figure, was derived from a 1994 study by William Bengen using a specific 30-year historical window. It was never meant to become a permanent universal law. A retiree withdrawing $40,000 per year in a high cost of living city faces median monthly expenses that can exceed $5,000, meaning the math collapses in under 17 years before a single health emergency enters the equation. The rule also assumed a 50-50 stock and bond portfolio in a period of relatively high bond yields, a market environment that no longer reliably exists, which structurally undermines the original assumptions from the starting point. Life expectancy has shifted the calculation further. A 65-year-old American today has a 50% chance of living past 85, and a meaningful chance of reaching 90 or beyond, stretching what a 30-year plan covers into a 25-year shortfall. Then, there's sequence of returns risk. The specific danger of a market crash in your first few retirement years, which can destroy a $1 million portfolio far faster than any calculator predicts, regardless of long-term averages. Add inflation at 3% annually, and $40,000 of year one spending requires $72,000 by year 20. $1 million is not a destination. It's a starting bid. And depending on where you live, what you eat, and how stubbornly long your genes plan to keep you alive, the auction ends much sooner than you planned. 2. Smart investors watch the signals, wait for the right moment, sell at the top, and ride off into a perfectly timed retirement sunset. This is one of the most durable fantasies in personal finance, and it has drained more retirement accounts than any market crash ever did. Market timing doesn't work. Not for professionals with Bloomberg terminals and research teams, not for algorithms running millions of calculations per second. Certainly not for you, watching charts on a laptop between dinner and sleep. A landmark Dalbar study tracking investor behavior over 30 years found the average equity investor earned roughly half the return of the S&P 500, entirely because of poorly timed buying and selling decisions, not poor fund selection. The damage isn't hypothetical. Missing just the 10 best trading days in any given decade cuts your total portfolio return by more than half. Those 10 days are statistically impossible to predict because they frequently occur during periods of maximum fear when every instinct you have tells you the market has further to fall. In 2020, the S&P 500 dropped 34% in 33 days, then recovered completely within 5 months. Investors who sold at the bottom locked in permanent losses while the market simply ignored their panic and moved on without them. Nobel Prize-winning economist Eugene Fama spent decades demonstrating that markets price available information almost instantly, making consistent short-term outperformance mathematically implausible for retail investors operating with the same public data as everyone else. Pre-retirees who attempt to protect their portfolio by shifting to cash before a predicted crash frequently miss the recovery and re-enter at higher prices, producing the single worst possible outcome. Vanguard's research shows that a simple, low-cost, stay-the-course index strategy outperforms the vast majority of actively managed and personally timed portfolios over 20-year periods. Timing the market is like trying to catch lightning in a jar, blindfolded during a storm with your retirement savings as the jar. The people who got it right once got lucky. Nobody reliably does it 3 times. 3, you paid into Social Security for 40 years. It'll be there. It'll cover the basics. That's what it was built for. This belief is not just wrong. It's the kind of wrong that leaves people genuinely unprepared for the specific financial reality of retirement. Social Security was designed to supplement retirement income, not replace it, and the average benefit barely covers rent in most American cities. The average Social Security retirement benefit as of 2024 is approximately $1,907 per month, roughly $22,884 per year. The federal poverty level for a single person sits at $15,060. The gap between above poverty and comfortable is a very wide canyon, and most people are standing on the wrong side of it with no plan. Social Security was introduced in 1935, when the average American life expectancy was 61. The system was not engineered to fund 25-year retirements for people who are genuinely healthy and active into their 80s. The Social Security Administration's own trustees report projects that the combined trust funds will be depleted by 2035, at which point incoming payroll taxes would only cover approximately 83% of scheduled benefits, meaning a potential automatic cut of 17% without congressional action. The replacement rate, what Social Security actually replaces of your pre-retirement income, averages around 40% for median earners. Financial planners broadly recommend replacing 70 to 80% of pre-retirement income to maintain your actual living standard. Medicare premiums, deducted directly from Social Security benefits, have risen substantially over time, quietly eroding the purchasing power of the check before it even hits your account. Claiming at 62 permanently reduces your benefit by up to 30%. Depending on Social Security alone for retirement is like showing up to a cross-country road trip with a quarter tank of gas and calling it a plan. It'll get you somewhere, just not where you want it to go. 4. Entering retirement debt-free is the gold standard. Eliminate the mortgage, eliminate the stress, simple, responsible, done. This sounds like wisdom. In a specific set of financial circumstances, it is wisdom. But applied as a blanket rule, which is exactly how most people apply it, aggressively paying off a low-interest mortgage while sacrificing investment contributions is one of the most common and quietly costly mathematical errors in pre-retirement planning. If your mortgage interest rate is 3.5% and your investment portfolio has historically returned 7 to 10% annually, every extra dollar thrown at the mortgage instead of invested is permanently forfeiting the compounding difference over time. That gap does not recover. A 2022 analysis by T. Rowe Price found that retirees who carried a modest, manageable mortgage while maintaining larger investment portfolios had significantly better long-term financial outcomes than those who eliminated the debt by drawing down retirement assets prematurely. Home equity is also deeply illiquid, which people forget until they need the money. A paid-off house cannot pay a grocery bill without a reverse mortgage, a home equity line of credit, or a sale, all of which carry their own costs, timelines, and complications that rarely materialize quickly or cheaply. Aggressively paying down a fixed-rate mortgage during a period of moderate inflation also means repaying debt with dollars worth less than those you borrowed, a subtle mathematical advantage for the borrower that most people discard in their rush toward a zero balance. The mortgage interest deduction, reduced by the 2017 Tax Cuts and Jobs Act, still provides some tax relief for itemizing homeowners, making the effective cost of the debt lower than the stated rate. To be clear, high-rate consumer debt should be eliminated aggressively. The myth is the blanket rule, not the situation-specific math. Torching your investment portfolio to pay off a 3% mortgage is the financial equivalent of burning your furniture to heat your home. Technically, you're warm. Structurally, you're in serious trouble. 5. Retirement is the hard stop. You hand in the badge, receive the cake, and never think about working again. That's the whole point. Decades of calendar counting followed by a clean exit, a complete and final separation from anything resembling professional activity. The all-or-nothing model of retirement sounds like freedom, but it is financially fragile, psychologically damaging, and increasingly out of step with how modern retirement actually functions in practice. A Merrill Lynch and AgeWave study found that 72% of pre-retirees say their ideal retirement includes some form of work, not because they have to, but because purpose, structure, and identity are not things a pension check replaces. The financial impact of part-time work in early retirement is mathematically enormous in ways that most people significantly underestimate. Earning even $20,000 per year for 5 years reduces portfolio withdrawals dramatically, extending the life of a nest egg by years, and in some cases by more than a decade. Bridge employment, working part-time or in a different capacity between a full career and full retirement, is associated with better physical health, lower rates of depression, and measurably sharper cognitive function in multiple longitudinal studies. The abrupt, full-stop retirement model was largely a product of mid-20th century industrial labor policy and defined benefit pension structures, not a timeless human ideal. For most of human history, people worked in reduced capacity until physical inability stopped them. The hard stop is a recent invention and not a particularly successful one. Social Security's earnings test, which temporarily reduces benefits for early claimants who continue working, is eliminated entirely at full retirement age, meaning continued income after 66 or 67 carries no Social Security penalty whatsoever. Treating retirement like a light switch, fully on one day, fully off the next, is a setup for financial stress and an identity crisis delivered simultaneously. A dimmer switch isn't failure, it's a considerably smarter way to handle the transition from fluorescent office lighting to whatever comes next. 6. No commute, no work wardrobe, no lunches out. Retirement is cheaper, everyone says so. The kids are gone, the mortgage is paid, and your expenses are going to fall off a cliff the moment you stop working. You hear this constantly from financial advisors, from friends who retired before you, from every retirement calculator you've ever used. It is also, for a meaningful percentage of retirees, completely wrong. Retirement spending frequently stays flat or rises, particularly in the first decade, because time is now the one thing you have in unlimited supply, and time has a consistent historical relationship with money. The go-go, slow-go, no-go framework, developed by retirement researcher Michael Steen, describes 3 distinct retirement phases. The first phase, the active early years, is typically the most expensive, driven by travel, dining, hobbies, and recreational spending that were previously constrained by the calendar and the work week. A Fidelity study found that retirees in their 60s spent more per capita than during their working years, driven primarily by increased discretionary spending once time constraints disappeared entirely. Healthcare costs, which increase predictably with age, partially or fully offset any savings from eliminated commuting or professional expenses. Fidelity's 2023 estimate puts average lifetime healthcare costs for a couple retiring at 65 at approximately $315,000. Before long-term care enters the equation. Home maintenance doesn't stop at retirement, and without the ability to defer repairs through a salary, the 1 to 2% of home value consumed annually by maintenance hits harder. Geographic relocation in retirement, often intended to reduce costs, carries one-time expenses in moving, real estate transactions, and community reestablishment that routinely run into tens of thousands of dollars. The 70 to 80% income replacement myth was partly built on data from retirees who were spending less than they wanted because they had no choice. Assuming your spending will collapse because you're no longer commuting is like assuming your grocery bill will drop because you stopped eating at your desk. You're still eating, you just have more time to do it somewhere expensive. 7. Once you retire, you get out of stocks. Bonds, certificates of deposit, cash, safe money only. You cannot afford to lose anything at this stage. This logic feels responsible, protecting what you built rather than gambling with it. But abandoning equities entirely in retirement is not playing it safe. It is guaranteeing you lose the race against inflation and longevity simultaneously in slow motion with mathematical certainty. A retirement lasting 25 to 30 years requires a portfolio to grow enough to outpace inflation across that entire period. Long-term treasury bonds and certificates of deposit have historically failed to match even moderate inflation rates on a real return basis, meaning a portfolio held entirely in these instruments is shrinking in purchasing power from the first day of retirement. The 100 minus your age in stocks rule which would put a 70-year-old at 30% equities, was developed in an era of meaningfully higher bond yields and considerably shorter average life expectancies. It has been widely abandoned by modern financial planners for exactly the reasons the math predicts. A landmark study by Wade Pfau and Michael Kitches showed that a rising equity glide path in retirement, actually increasing stock allocation in the early years, produced better long-term outcomes than the traditional declining equity approach that most people follow by reflex. Inflation at 3% cuts purchasing power in half in roughly 24 years. A retiree who lives to 92, having retired at 65, needs their money to maintain purchasing power across nearly 3 decades, which no bond-heavy portfolio has consistently delivered. The sequence of returns problem is real and worth addressing, but the resolution is a cash buffer of 1 to 2 years of living expenses, not total equity abandonment. Vanguard's research shows that a portfolio of 50% equities and 50% bonds has historically outperformed all bond portfolios over 20-year periods, even accounting for volatility. Pulling all your money out of the stock market because it feels risky is like refusing to eat anything but crackers for 30 years because you once had a bad meal. The risk you're trying to avoid is smaller than the one you're creating. 8. You turn 65, Medicare kicks in, and healthcare is handled. That is what you paid into the system to receive. This belief is so widespread and so specifically wrong that it shapes financial plans in ways that produce genuine hardship at the exact moment people are least equipped to absorb it. Medicare covers a meaningful but deeply incomplete slice of your healthcare needs, and the gaps, dental, vision, hearing, long-term care, are precisely the services that become expensive and necessary as you age. Original Medicare Parts A and B does not cover routine dental care, routine vision exams or eyeglasses, hearing aids, or most long-term care. These are not obscure edge cases. They are the most common and costly age-related health needs a person faces across a 20 to 30-year retirement. Medicare Part B carries a standard monthly premium of $174.70 in 2024, plus 20% coinsurance with no out-of-pocket maximum under Original Medicare, meaning a catastrophic illness produces unlimited personal financial liability. The average hearing aid costs $2,000 to $7,000 per device. Dental implants run $3,000 to $5,000 per tooth. Neither is covered under standard Medicare, and neither is cosmetic or optional. They are functional health requirements. Long-term care is categorically excluded from Medicare beyond a narrow window of up to 100 days of skilled nursing following a qualifying hospital stay. The median annual cost of a private nursing home room in the United States currently exceeds $108,000. Medigap supplemental policies, which cover many of these gaps, carry their own premiums ranging from $100 to $400 or more per month. Fidelity's 2023 estimate puts total healthcare costs for a 65-year-old couple in retirement at approximately $315,000. Counting on Medicare to cover your retirement, healthcare is like buying a car that includes the engine, but not the wheels, the windshield, or the brakes. And then acting surprised when the road gets complicated. 9. Delay, delay, delay. Waiting until 70 to claim Social Security maximizes your benefit. That is just math. Everyone knows it. And it is true, for a specific set of people under a specific set of circumstances. The problem is the word always, which converts a situationally accurate observation into a blanket rule that ignores health status, spousal dynamics, and financial need in ways that can genuinely cost you real money over a real lifetime. Claiming at 70 versus 62 produces a monthly benefit approximately 76% higher. The break-even point, where the cumulative larger payments exceed the cumulative smaller but longer payments, typically falls around age 80 to 82. If you have reason to believe your life expectancy falls below average due to documented health conditions or family history, claiming earlier can produce higher lifetime benefits than waiting full stop. Married couples face a more complex optimization problem entirely. Spousal and survivor benefits mean the higher earner's claiming age dramatically affects the surviving spouse's income for potentially decades after. usually favoring delay for the higher earner regardless of individual health, but requiring specific modeling of both partners' situations rather than a one-size-fits-all rule. For people who retire at 62 without pension income, delaying Social Security to 70 while drawing down savings for 8 years can deplete a portfolio to the point where the larger eventual benefit is cold comfort against a diminished account balance. The Social Security break-even calculation also ignores the opportunity cost of not investing early benefits, a variable that shifts the math further depending on the portfolio's actual returns during the waiting years. Tax implications compound the issue. In certain income ranges, Social Security benefits are partially taxable, which can erode the advantage of the larger delayed benefit more than surface-level comparisons suggest. Always wait until 70 is a rule written for someone else's life expectancy, someone else's marriage, and someone else's savings account. The right answer for you requires math, not mythology. 10. The 4% rule. Withdraw 4% of your portfolio annually and you will never run out of money. It is the science of retirement income, the received wisdom of an entire profession, repeated in every personal finance book and retirement seminar with the confidence of a physical law. The problem is that it is not a physical law. It is a historical observation derived from a single study built on conditions that have materially changed, and its own creator has since publicly walked back its universal application. William Bengen published the original study in the Journal of Financial Planning in 1994 using United States market data spanning 1926 to 1976. His research was never intended to produce a permanent universal rule. It was a historical analysis of a specific asset allocation across a specific time horizon. Bengen himself later clarified that 4.5% was defensible with broader portfolio diversification, and separately acknowledged that the rule assumed a 30-year retirement, not the 35 to 40-year retirements becoming increasingly common today. Research by Pfau and others using international market data found the 4% withdrawal rate would have failed in numerous global markets throughout the 20th century, suggesting the rule reflects American market exceptionalism as much as it reflects financial science. Low interest rate environments, like those seen in the decade following 2008, compressed the fixed income returns that made the 4% projection sustainable in Bengen's original model. A sequence of returns shock in the first 5 years of retirement can render the 4% rule mathematically unsustainable even if long-term average returns eventually recover, because the depleted portfolio has less capital compounding through the recovery. Morningstar's 2021 research suggested a starting withdrawal rate of 3.3% was more appropriate given market valuations and interest rate environments for a 90% success probability over 30 years. The 4% rule is not a law of physics. It is a historical observation built on specific conditions that have since shifted, and treating it as scripture is exactly the kind of plan that reads beautifully on paper until reality doesn't cooperate. 11. Less income in retirement means lower taxes. You'll barely owe anything. That's one of the perks of getting out. This assumption is so intuitively appealing and so specifically expensively wrong for diligent savers that it shapes retirement account decisions in ways people regret for the following 2 decades. For anyone who saves seriously in traditional tax-deferred accounts, retirement can trigger surprisingly elevated tax bills, sometimes higher than the bills they were paying during their peak earning years. Required minimum distributions from traditional 401k plans and IRAs begin at age 73 under the Secure 2.0 Act of 2022. And they are calculated on the entire account balance, not what you need to live on, but what the IRS requires you to withdraw. Large balances produce large mandatory taxable income whether you want it or not. These RMDs can push retirees into higher marginal brackets, cause Social Security benefits to become partially taxable. Up to 85% of benefits are taxable above certain income thresholds. Trigger Medicare IRA surcharges on Part B and Part D premiums and reduce the deductibility of medical expenses simultaneously. The taxation torpedo, a well-documented phenomenon in retirement tax planning, occurs when multiple income streams, RMDs, Social Security, pension income, and investment returns, stack in a single year and produce a marginal effective tax rate far exceeding anything the retiree anticipated. A 2019 paper by David Blanchett found that a meaningful percentage of retirees with significant 401k balances face higher effective tax rates in retirement than during their final working years. Tax rates themselves carry additional uncertainty. The individual provisions of the 2017 Tax Cuts and Jobs Act are scheduled to sunset after 2025, potentially reverting to higher pre-2018 brackets absent congressional action. Roth conversions during the gap between retirement and RMD start dates represent one of the most powerful tax reduction strategies available to retirees, yet most people never execute them. Assuming retirement automatically means lower taxes is like assuming a smaller house automatically means lower bills. Once you add everything you didn't see coming, the number looks nothing like what you imagined. 12, you raise them. They will return the favor if things get tight. Family takes care of family. This belief is emotionally understandable, culturally reinforced, and financially destructive for everyone it involves. The parents who count on it, and the children who get counted on without being asked. Banking on adult children as a retirement safety net is one of the most quietly harmful plans a person can construct, and it usually doesn't survive contact with the actual financial situation of the next generation. A Bankrate survey found that 68% of parents have made financial sacrifices for their adult children, including drawing down retirement savings, meaning the financial flow reliably moves in the opposite direction of the one being assumed. The median American millennial household carries significant student debt, faces housing costs as a percentage of income higher than any prior generation, and is simultaneously expected to fund its own retirement without the defined benefit pensions that made the previous generation's savings math more forgiving. The financial planning principle on this point is consistent enough to be called consensus. You can borrow money for college, a car, or a house. You cannot borrow money to fund a 20-year retirement. Prioritizing your own savings over transfers to adult children is not selfishness. It is the structural reality of how retirement math works. Financial dependence on adult children ranks among the top drivers of family conflict in surveys of both family therapists and financial planners, damaging relationships precisely when emotional connection matters most. In countries without robust public retirement systems, elder financial dependence on children has been studied extensively, consistently producing worse outcomes for both generations. Reduced retirement savings for the children and insufficient, unpredictable support for the parents. Estate planning attorneys report that inheritance expectations misaligned with actual account balances are among the most painful family surprises they regularly witness. Counting on your children as a retirement plan is not a safety net. It is a trap you are building for people you love, disguised as something that sounds like family values. 13. Debt in retirement is failure. You should have zero debt before you stop working. That is the responsible thing. The responsible thing is understanding the difference between productive debt and destructive debt. A distinction that can cost you years of compounding returns and in some cases unnecessarily delay retirement while you chase a psychological milestone that was never financially necessary to begin with. Low-rate fixed debt, a mortgage at 3%, a car loan at 2.5%, is not financially equivalent to high-rate consumer debt carrying 22% interest. Treating them identically and aggressively, eliminating both at the expense of investment contributions, is a mathematical error dressed up as a virtue. A certified financial planner analysis published in the Journal of Financial Planning found that households that prioritize maxing out tax-advantaged accounts over paying off low-rate mortgage debt accumulated significantly more wealth over 20-year periods. The gap is not trivial. At a 7% investment return versus a 3% mortgage rate, every dollar redirected from the mortgage to a tax-advantaged investment account produces 4% of annual compounding advantage, annually, for however many years remain before retirement. Good debt in retirement can include a home equity line of credit used strategically as a cash flow buffer, or a reverse mortgage used to reduce portfolio withdrawal pressure during market downturns, both of which treat debt as a planning tool rather than a character failure. The pressure to eliminate all debt before retiring often pushes people to delay retirement by years, working past the point of health or desire in pursuit of a zero balance status that was never actually required by the underlying financial math. Aggressively paying down a fixed-rate mortgage during a period of moderate inflation also means repaying debt with dollars worth less than those originally borrowed. A subtle but real mathematical advantage for the borrower. The myth is the blanket rule. Refusing to retire until you have zero debt of any kind is like refusing to start cooking dinner until the kitchen is perfectly spotless. The kitchen will get dirty again, and you have been hungry for a long time. 14. Inflation is something other people worry about. You'll have a fixed income. Things cost what they cost, and you will adjust. This particular myth is not just wrong, it is the variety of wrong that compounds silently year after year, until the gap between what your money was supposed to buy and what it actually buys becomes impossible to ignore or close. Inflation is the relentless, mathematically certain erosion of purchasing power, and it is the single most predictable threat to a long retirement that most retirement plans treat as an afterthought. At a 3% annual inflation rate, roughly the long-term historical average, purchasing power is cut in half in approximately 24 years. A retiree who lives to 89, having retired at 65, experiences this complete halving. The 2021 to 2023 inflationary period saw United States CPI peak at 9.1% in June of 2022, the highest reading in 40 years, demonstrating that inflationary risk is not theoretical. It arrived, and it specifically devastated people on fixed retirement incomes. Healthcare inflation has historically run 1 to 2 percentage points above general CPI, and since healthcare costs rise as a percentage of total retirement spending with advancing age, retirees face a compounding double burden that general inflation figures significantly understate. Social Security provides a cost of living adjustment that partially tracks inflation, but the COLA calculation uses CPIW, a wage earner index, not a measure that accurately reflects the spending patterns of older Americans who spend considerably more on healthcare and considerably less on transportation and technology. Fixed pension payments, still relevant for a portion of retirees, frequently carry no inflation adjustment whatsoever, meaning their real value erodes predictably and permanently from the first payment date. Planning a retirement budget without modeling inflation produces projections that grow increasingly optimistic as time passes. Mapping a road trip without accounting for the fact that the roads get longer as you drive produces similar results. The destination looks close on paper. The real journey is something else entirely. 15. You hire a financial advisor, hand over the accounts, and the problem is solved. They are the expert. That is their job. This is one of the most understandable and most expensive misconceptions in personal finance because it conflates delegation with abdication. And the industry's compensation structures contain enough conflicts of interest that uninformed delegation can quietly cost more than you will ever calculate. A financial advisor is only as valuable as your understanding of what they are actually doing and how they are being paid to do it. The United States financial advisory industry operates under two distinct standards. The fiduciary standard legally requires an advisor to act in your best interest. The suitability standard only requires an advisor to recommend products that are suitable, not necessarily optimal, for your situation. Many advisors operate under the lower standard and are not legally required to proactively disclose the difference to you. A 2015 White House Council of Economic Advisors report estimated that conflicted financial advice costs retirement savers approximately $17 billion annually in suboptimal returns, primarily through fee-laden product recommendations that serve the advisor's compensation before the client's portfolio. Commission-based advisors are compensated when they sell specific products, annuities, mutual funds with front-end loads, certain insurance products, creating structural incentives that may not align with what is mathematically best for your retirement. A 1% annual advisory fee, which sounds negligible, reduces the final value of a portfolio over 30 years by approximately 25% compared to the same portfolio managed with a 0.05% expense ratio index fund. On a $1 million portfolio, that difference can exceed $250,000 over time. The fee-only fiduciary model, where advisors charge a flat fee or hourly rate and receive no product commissions, represents the cleanest structural alignment of interests. Far fewer advisors operate this way than the industry implies. Hiring a financial advisor and then disengaging entirely is not a retirement plan. It is an outsourcing of responsibility to someone whose incentive structure you probably have not read. 16. Annuities are either the greatest financial product ever invented or the worst thing you can do with your money. Pick your camp. One of them is right. This binary, tribal argument about annuities has consumed an enormous amount of financial media oxygen and produced almost no actual clarity for the people who need to make a real decision about whether a specific product solves a real problem they actually have. Both camps are wrong. Annuities are a tool, one that is frequently oversold, frequently misunderstood, and occasionally exactly right for a specific situation involving a specific person's income needs, longevity risk, and psychological relationship with market volatility. The core problem is that multiple fundamentally different products share the same name. Simple income annuities are straightforward lifetime income contracts. Variable annuities are complex, fee-laden investment wrappers with insurance riders attached. Fixed indexed annuities track market indexes with downside protection and opaque fee structures. Deferred income annuities provide longevity insurance beginning at an advanced age. Lumping all four categories together is like calling a bicycle and an 18-wheeler the same vehicle because they both have wheels. Variable annuities sold with guaranteed living benefit riders carry total annual fees that can reach 3 to 4%, a number that makes it functionally impossible for the underlying investments to generate returns that justify the cost. FINRA and the SEC have both published investor alerts regarding the aggressive marketing of variable annuities, particularly the use of bonus features that are routinely clawed back through fee structures over time. A simple immediate annuity, where you provide a lump sum and receive guaranteed monthly income for life, is genuinely effective at solving the longevity insurance problem with relative transparency. Academic research by Moshe Milevsky and others demonstrates that annuitization improves welfare outcomes for risk-averse retirees. But that research describes immediate annuities, not what commission-driven advisors typically recommend. The question is not whether to hate annuities on principle. It is whether this specific contract at this specific price solves a real problem you actually have. 17. You're healthy, you exercise, you take care of yourself. Long-term care is for other people. This belief is emotionally comfortable and statistically unsound. Long-term care risk is not primarily a function of your current health status. It is a function of your future longevity. And the longer you live, the higher the probability of a period requiring significant care, regardless of how you feel at 65. The United States Department of Health and Human Services estimates that 70% of Americans turning 65 today will require some form of long-term care services in their lifetime. Current health status at retirement is not a reliable predictor of this outcome. The median annual cost of a private room nursing home in the United States currently exceeds $108,000. Home health aid services average $61,000 annually. These are not rare, catastrophic outliers. They are predictable financial events for the statistical majority of retirees. Medicaid does cover long-term care, but only after you have spent down virtually all of your assets to a very low threshold. Planning to use Medicaid as a long-term care strategy is a plan to become financially destitute before the coverage begins, which is a specific choice some people make deliberately, but rarely the one they thought they were making when they had decided long-term care insurance was unnecessary. Long-term care insurance premiums are significantly lower when purchased in your 50s than your 60s, and many people who wait until their 60s are uninsurable due to health conditions that developed during the interval between the decision and the application. The spousal care burden adds a hidden layer of cost that no balance sheet captures. Family members who provide informal care experience measurable reductions in their own workforce participation, retirement savings, and personal health outcomes. Hybrid life insurance and long-term care products have grown substantially as traditional carriers have exited the market, providing a death benefit if care is never needed and addressing the use it or lose it objection. Deciding you don't need long-term care coverage because you're currently healthy is like deciding you don't need a fire extinguisher because your house isn't currently on fire. The risk you're planning against isn't your present, it's your future. 18, your home equity is your real retirement asset, and if things get bad, you'll sell the house. You have a lot of equity in there. That is your backup plan. Home equity is real wealth, but it is illiquid, geographically constrained, and consistently overestimated as a retirement income source in ways that only become apparent when people actually try to access it under real conditions. Accessing home equity requires either selling the property and then paying for housing somewhere else, taking on a home equity line of credit with its own interest costs and qualification requirements, or obtaining a reverse mortgage with fees, interest accrual, and terms that take time to understand. Downsizing sounds straightforward until you account for agent commissions averaging 5 to 6%, closing costs, moving expenses, and the reality that in many markets, smaller homes are nearly as expensive as larger ones, producing an equity arbitrage far thinner than the original assumption. Home values are also not guaranteed to rise. The 2008 financial crisis saw median home values decline 30% or more in major United States markets, with some areas taking a decade to recover. Retirees who needed to access equity between 2009 and 2012 did so at deeply disadvantaged prices, precisely when they needed the money most. Property taxes, homeowners insurance, maintenance, and utilities represent ongoing costs that persist with a paid-off mortgage and continue rising with inflation, consuming a growing share of fixed retirement income over time. Emotional attachment to the family home frequently overrides financial logic, leading retirees to maintain expensive properties longer than makes financial sense, delaying equity conversion until circumstances force it under suboptimal conditions rather than strategic ones. Your house is not a savings account. It is an asset with transaction costs, maintenance costs, and an emotional price tag that makes rational liquidation harder than any spreadsheet suggests. Counting it as your only backup plan is a different thing from counting it as one piece of a broader strategy. 19. You own 25 different stocks across several sectors. You are diversified. You are covered. This feels like a reasonable conclusion. Variety suggests protection, and spreading money across different companies sounds like exactly what diversification means. It is not. Owning many individual stocks is not diversification in any meaningful financial sense, and the distinction between the appearance of diversification and the reality of it can quietly expose your retirement savings to the full force of market swings you believed you had reduced. A portfolio of 25 United States large-cap growth stocks carries a correlation coefficient approaching 0.95 with the S&P 500, meaning it moves almost identically to a single index fund. You have added research complexity and transaction costs without reducing your actual risk by any measurable amount. Modern portfolio theory, for which Harry Markowitz won the Nobel Prize in Economics in 1990, demonstrates that genuine risk reduction comes from combining assets with low or negative correlations, not from holding more of the same correlated assets under different ticker symbols. The United States stock market represents approximately 60% of global stock market capitalization. A portfolio held entirely in domestic equities ignores 40% of the investable world and concentrates geopolitical and currency risk within a single nation whose market performance is not guaranteed to continue outperforming. True asset class diversification, equities, fixed income, real assets, international developed markets, emerging markets, real estate investment trusts, produces measurably different risk-return profiles than holding multiple companies within a single asset class. Peter Lynch coined the term diversification to describe holding so many individual stocks that you have essentially recreated an index fund at higher cost with the illusion of customization. Target date funds, imperfect as they are, represent genuine multi-asset class diversification that most self-directed stock portfolios never achieve, at expense ratios as low as 0.1%. Owning 25 tech-adjacent domestic large caps and calling it diversification is like eating 25 flavors of ice cream and calling it a balanced diet. The variety is real, the protection is not. 20, you max out the 401k every year. You are a disciplined, responsible saver. The retirement problem is solved. This deserves genuine credit. Maxing a 401k consistently is better than what most Americans manage, and the habit is worth maintaining. But for a meaningful number of households, maximum annual contributions to a single tax-deferred vehicle still fall short of funding a multi-decade retirement when healthcare costs, inflation, and actual longevity are modeled honestly rather than optimistically. The 2024 401k contribution limit is $23,000 or $30,500 with catch-up contributions for those 50 and older. A 40-year-old who maxes contributions for 25 years at a 7% average annual return accumulates approximately $1,500,000, which, after applying a 4% withdrawal rate, produces $60,000 annually before taxes. For many households in major metropolitan areas, that figure falls below current living expenses before accounting for healthcare or inflation. A 401k is a tax-advantaged savings vehicle, not a retirement income strategy. The difference is significant. Accumulating the right amount in the right accounts using the right withdrawal sequence at the right effective tax rate requires deliberate planning that goes well beyond the act of contributing into each year. 401k investment menus are frequently limited and carry a higher expense ratios than what the same contributions would produce in a low-cost individual retirement account or taxable brokerage account. Non-retirement savings, Roth IRAs, taxable brokerage accounts, real estate, business equity, provide flexibility, tax diversification, and access that's tax-deferred 401k balances structurally cannot. Relying entirely on a single savings vehicle is its own form of concentration risk, regardless of how consistently you fill it. Maxing your 401k and declaring retirement solved is like making every mortgage payment on time and assuming the house is ready to sell. You did the right thing. There is still considerably more to the plan than one right thing done well. 21. The kids are gone. You do not need all that space. Downsize immediately. Bank the equity. Simplify your life. It is the obvious move, and everyone around you will confirm it enthusiastically the moment you mention retirement. Immediate downsizing at retirement is a reflex, not a strategy, and for many people it is a financially and personally premature decision made under cultural pressure rather than actual analysis of what their life will require across the next 30 years. Early retirees who downsize immediately may find themselves in a smaller space for 3 decades, constraining their ability to host family members, maintain social routines, or accommodate changing physical and caregiving needs that they cannot yet predict. Transaction costs of selling and buying, real estate commissions averaging 5 to 6%, closing costs, moving expenses, and the cost of furnishing and modifying a new home routinely consume $50,000 to $100,000 of the apparent equity gain before the financial benefit materializes. In many major markets, smaller homes, condominiums, and townhomes have appreciated nearly as fast as larger properties, compressing the equity arbitrage that made the downsizing calculation historically attractive. Homeowners association fees associated with smaller community living can run $300 to $800 per month, partially or fully offsetting the reduced maintenance advantage that the move was supposed to deliver. Research consistently shows that retirees who downsize prematurely report lower life satisfaction, reduced ability to maintain social routines, and a diminished sense of stability during a period already defined by significant transition. A phased approach, evaluating housing needs at retirement, again at 70 and again at 75, tends to produce better outcomes than a single early decision made under the assumption that what your life looks like today is what it will look like in 20 years. Downsizing. The day you retire because you no longer need the space is like trading in a reliable car the day you stop commuting. The running costs drop slightly. You made a permanent decision based on a temporary change. 22. Even if the market crashes, it always comes back. Just hold on. History proves it. This is true in the aggregate and dangerously misleading in its application to individual retirement timelines, because the word eventually is doing enormous structural damage to anyone who needs their money during the period the market refuses to cooperate. The stock market does recover, eventually. The problem is what happens to your portfolio while it is taking its time. The Nikkei 225, Japan's primary stock index, peaked in December of 1989 at approximately 38,915. It took over 34 years to return to that level, meaning Japanese investors who retired in 1990 experienced decades of nominal loss. United States market exceptionalism is a real historical phenomenon, not a law of nature that other markets are required to follow. The S&P 500 lost approximately 50% from October of 2007 to March of 2009. A retiree withdrawing $50,000 per year during that period was forced to sell at depressed prices, permanently impairing the portfolio's capacity to recover at the same rate as the index. Sequence of returns risk, the specific danger of a market crash in the early years of retirement, has been extensively modeled, and the finding is consistent. Two retirees with identical 30-year average returns can have entirely different outcomes based solely on which years the losses arrived. A 10-year recovery feels manageable for a 45-year-old accumulating assets. For a 65-year-old in distribution, it represents a potentially portfolio-ending stretch. The resolution is not to avoid equities, but to maintain a cash and short-term bond buffer of 1 to 3 years of living expenses, allowing equities to recover while income needs are met from non-equity assets. The market will recover. The question is whether it recovers before or after you have been forced to sell the bottom to pay your bills. 23. Wills and trusts are for people with mansions and accountants. You do not have enough to worry about estate planning. This belief is so widespread that it has produced an entire category of preventable family crisis. Because estate planning has almost nothing to do with the size of your estate and almost everything to do with what happens to the people around you when you can no longer speak for yourself, which is a circumstance that affects everyone regardless of net worth. Dying without a will means your state's default intestacy laws determine who receives your assets. A formula that frequently diverges from your actual intentions, particularly in blended families, unmarried partnerships, and situations involving minor or disabled beneficiaries. Beneficiary designations on 401k accounts, individual retirement accounts, and life insurance policies supersede wills entirely. An outdated beneficiary designation, naming a deceased spouse, an estranged sibling, or a former partner, distributes assets against your wishes and cannot be legally contested after death regardless of what your will says. A durable power of attorney and healthcare directive are arguably more immediately important than a financial will. Without them, a family must petition for court-ordered guardianship to manage your affairs during incapacity, a process that is expensive, slow, and public, and that typically arrives precisely when the family is already under maximum stress. Probate, the legal process validating a will and distributing assets, commonly takes 12 to 18 months, is publicly accessible, and costs 3 to 7% of estate value in some states. A revocable living trust, which typically costs $1,500 to $3,000 to establish, avoids probate entirely, maintains privacy, and transfers assets of any size seamlessly to named beneficiaries. Digital assets, cryptocurrency, online accounts, business platforms, represent a growing estate planning gap that traditional documents fail to address without explicit provisions. Not having an estate plan because you're not rich enough is like not having a fire escape plan because your house isn't fancy enough to burn. 24. The earlier you retire, the better. More years of freedom. More time to travel, pursue your passions, and actually enjoy your life before you are too old to do it. Why wait? Early retirement is a legitimate goal held by millions of people who have thought carefully about what they want from life, and the appeal is real. But it solves a time problem while creating a financial and psychological problem set that the broader movement toward early retirement significantly underrepresented in its promotional material. Every year of early retirement creates a two-sided financial burden simultaneously. One fewer year of income and savings contributions, and one additional year of portfolio withdrawals. Retiring at 50 instead of 65 can require nearly twice the savings to fund the same standard of living across a longer horizon. The widely cited 25 times annual expenses savings target, derived from the 4% rule, was built on a 30-year retirement. A 40-year-old who retires faces a potential 50-year retirement, requiring a multiplier closer to 33 to 40 times annual expenses to achieve the same probability of success. Social Security benefits are calculated using your highest 35 earning years. Retiring early with fewer high earning years permanently reduces your eventual benefit, sometimes by 20 to 30%, compounding the financial gap between early exit and sustainable income. Healthcare coverage is the most consistently underestimated cost of early retirement. Affordable Care Act marketplace premiums for a couple in their mid-50s can run $1,500 to $2,500 or more per month before subsidies, a cost that early retirees frequently miscalculate when building their initial plan. Research on health outcomes for early retirees is genuinely mixed, with some European and Japanese studies showing elevated cognitive decline and mortality risk in men who retire before 65 without purposeful substitute activities. Retiring at 50 can be the best decision you ever make if you built a plan for a 50-year horizon rather than a 30-year one. The freedom is real. The math does not care how free you feel. 25, your 30s are for mortgages, children, and everything else life throws at you. You will get serious about retirement in your 40s. There is plenty of time. This is survivable advice in the sense that starting at 40 is dramatically better than starting at 50. But the belief that the delay carries no meaningful cost is one of the most financially damaging myths in personal finance. Because what you lost in your 30s is not money. It is time, and time in a compounding system is the one input that cannot be purchased or recovered at any price. The rule of 72 states that money doubles at a rate equal to 72 divided by the annual return. At 7%, money doubles every 10 years. A dollar saved at 25 doubles 3 times by 55, becoming $8. A dollar saved at 45 doubles once by 55, remaining $2. The gap is not a rounding error. It is permanent, and it scales with every dollar not contributed during the delay. A person who contributes $500 per month from age 25 to 35 and then stops entirely will, at 65, hold more money than a person who contributes $500 per month continuously from age 35 to 65. Entirely because of the 10-year compounding head start. 401k contribution limits impose annual ceilings. Missing years of maximum contributions in your 30s creates a permanent gap that catch-up contributions of $7,500 per year after 50 only partially close. The emotional cost of aggressive savings rates in your 40s and 50s is also real. Saving 20 to 25% of income to compensate for a late start creates genuine lifestyle compression during the years when children are leaving, homes need upgrading, and career expenses are peaking. Starting at 40 is meaningfully better than starting at 50. The myth is the belief that the decade you lost came at no cost. 25 compounding years ran without you. That race does not have a restart button. 26, if you have a pension, you are set. It is guaranteed income for life. That is what defined benefit means. Defined, promised, guaranteed. The word guaranteed carries enormous psychological weight in retirement planning, which is precisely why it matters that pensions are only as safe as the institution that funds them. And the public record of pension funds that have failed, cut benefits, or required emergency federal intervention is long enough to warrant reading before you build a retirement plan around a single promise from a single institution. The Pension Benefit Guaranty Corporation, the federal agency insuring private sector pensions, provides maximum benefit guarantees that can fall far below what a retiree was promised. As of 2024, the maximum PBGC guarantee for a 65-year-old is approximately $7,362 per month, a ceiling that becomes a floor for high earners who expected significantly more. In 2013, the city of Detroit's bankruptcy produced cuts to public employee pensions that had been considered constitutionally protected under Michigan state law. The case became a defining demonstration that guaranteed pensions can be materially impaired in municipal insolvency. The PBGC's own multi-employer program, covering union pensions shared across multiple employers, has been chronically underfunded. The American Rescue Plan of 2021 provided $86 billion in emergency relief, but the structural underfunding of multi-employer pensions remains an unresolved long-term concern. Illinois, New Jersey, and Kentucky have been repeatedly cited by credit rating agencies for pension liabilities representing structural fiscal risks. Private company pensions can be frozen, ending benefit accrual from the freeze date, or terminated and converted to lump sums that frequently undervalue the actuarial present value of the promised lifetime benefit. Lump sum offers are often made at a discount that benefits the employer at the recipient's long-term expense. A pension is a promise backed by an institution. Institutions have histories, and some of those histories include congressional rescue packages. 27. Life insurance is for people with dependents. Once the children are grown and the mortgage is paid, cancel the policy. You do not need it anymore. The logic seems airtight. The original purpose of replacing your working income for a dependent family no longer applies at retirement. But this reasoning leads to blanket cancellation without analysis, and blanket cancellation without analysis of your specific situation misses several legitimate and sometimes significant uses for life insurance that have nothing to do with replacing a working income for minor children. Survivor income replacement for a spouse remains a genuine need in retirement, specifically because Social Security survivor benefits mean the death of the higher earning spouse permanently eliminates the lower of the two monthly benefits. A life insurance policy can replace that structural income loss for the surviving spouse's remaining years, a period that could easily extend to 15 or 20 years depending on the age gap and health of both partners. Final expense coverage. Funeral costs averaging $8,000 to $12,000, unresolved medical bills, and estate settlement expenses falls directly to survivors when no coverage exists. For families without substantial liquid assets, this is a concrete financial hardship arriving at the worst possible time. Permanent life insurance with cash value can function as a tax advantage, supplemental savings vehicle, a long-term care funding mechanism through policy riders, or an estate equalization tool in situations where illiquid assets like a family business or real estate create an unequal distribution problem among heirs. An irrevocable life insurance trust is a commonly used estate planning tool that removes insurance proceeds from the taxable estate, passing wealth to heirs tax-free, a strategy that requires maintaining the underlying policy throughout retirement. Life insurance needs to legitimately decrease at full financial independence for many retirees. The myth is the reflex cancellation without asking whether the need has changed or simply shifted. Canceling every policy at retirement because the kids are grown is like removing every smoke detector because you have not had a fire in 20 years. The need changed. Whether it disappeared entirely is a separate question. 28. Bonds and cash. Safe. Predictable. You are protecting what you built, and that is the entire point of the conservative portfolio. The behavioral appeal of a low volatility retirement portfolio is real. Sleeping well matters, and a retiree who maintains a stable allocation and avoids panic selling during corrections may outperform a theoretically superior portfolio they would have abandoned at the worst moment. But an overly conservative portfolio in retirement carries its own profound and often invisible risk. The risk of outliving your money while your purchasing power erodes across 20 to 30 years of fixed income returns that fail to keep pace with inflation. A portfolio of 100% bonds or cash equivalents in a low to moderate yield environment generates real returns after inflation that are negative or marginally positive at best. The portfolio is shrinking in purchasing power from day one, reliably, predictably, and with mathematical certainty that has nothing to do with market volatility. Research by Michael Kitchis shows that a retiree with a 30-year horizon and an all-bond portfolio faces a meaningful failure probability even at modest withdrawal rates, higher counterintuitively than a 50-50 or 60-40 portfolio held across the same period. The standard definition of conservative and retirement investment is contextually broken. Conservative is supposed to mean protected, but low volatility combined with insufficient return in a long retirement does not produce protection. It produces a slow-motion solvency problem that feels completely stable until the day it isn't. Sequence of returns risk, the genuine danger in early retirement, is best managed through cash buffers and dynamic withdrawal strategies, not through permanent underweighting of growth assets across 3 decades. Vanguard research shows that 50% equity portfolios have historically outperformed all bond portfolios over 20-year periods, even accounting for volatility. A conservative portfolio that cannot keep pace with inflation is not playing defense. It is playing offense for the wrong team. You are not protecting your wealth. You are watching it shrink more slowly and calling that a plan. 29. You are healthy now, so your healthcare costs in retirement will be manageable. Unhealthy people spend a lot. Healthy people do not. This sounds like reasonable extrapolation from current evidence. It is not. Current health predicts near-term healthcare costs with some reliability. It predicts long-term retirement healthcare costs poorly. Because longevity is the primary driver of lifetime healthcare expenditure, not the health status you arrive at 65 with. A healthy 65-year-old who lives to 92 faces 27 years of accumulating healthcare costs. An individual in poor health at 65 who lives to 75 faces 10. The healthy person's lifetime healthcare expenditure is almost certainly higher, despite better health throughout, simply because they have more years to accumulate the costs. Healthcare spending in the final 2 years of life is among the highest of any period. And that expensive final chapter occurs eventually for nearly everyone, regardless of how healthy the middle chapters were. The correlation between self-reported health at 65 and healthcare expenditures at 80 is weak in the research literature. Conditions that are expensive to manage, dementia, cardiac disease, cancer, frequently develop in people who were objectively healthy at retirement. HealthView Services estimates that a healthy 65-year-old couple will spend an average of $662,000 in total lifetime healthcare costs, including premiums, copays, and out-of-pocket expenses. A number that increases, not decreases, with longevity. Long-term care costs, the largest single healthcare wildcard in retirement, are statistically more common in people who live longer, not specifically in people who entered retirement in poor health. The planning implication is counterintuitive and worth repeating. Genuinely healthy people should plan for more healthcare spending in retirement, not less, because they are more likely to be present for all of it. Being healthy at 65 does not reduce your lifetime healthcare budget. In many ways, it expands it. Plan accordingly. 30. Move somewhere cheap. Low taxes, lower cost of living, smaller overhead, problem solved. You can stretch any retirement income if you pick the right zip code. Geographic arbitrage is a real and genuinely powerful retirement strategy. The gap between living costs in Manhattan and living costs in a mid-sized Midwestern city is wide enough to change the financial outcome of a retirement plan in meaningful ways. But cheap to live comes with hidden costs that frequently surface over a long retirement in ways that are expensive, sometimes irreversible, and rarely visible from the spreadsheet where the original decision was made. Healthcare access in rural low-cost areas is a documented and worsening problem. 181 rural hospital closures occurred between 2010 and 2023, and the United States rural physician shortage affects the quality and accessibility of medical care in precisely the areas most marketed as retirement destinations for their affordability. As your need for health care increases with age, the distance between where you live and where competent care exists becomes a logistics problem with a real financial and physical cost. Social capital, relationships, professional networks, community connections, is lost entirely in a geographic relocation and is extremely difficult to rebuild in retirement when the workplace no longer provides organic social structure. State tax environments vary significantly, but property taxes, sales taxes, cost of healthcare, and quality of services alter the full calculation well beyond the income tax rate that most relocation decisions anchor on. A 2019 Merrill Lynch study found that retirees who relocated primarily for financial reasons reported lower satisfaction than those who relocated for family proximity or lifestyle reasons. Moving costs, real estate transaction costs, and capital required to establish housing in a new location can consume $50,000 to $100,000 upfront, partially offsetting years of projected savings through lower living costs. Cheap and good are not the same word, and reversing a geographic decision in your 80s is one of the more expensive things you can arrange. 31. Financial planners always say you need 70 to 80% of your pre-retirement income once you've stopped working. That is the benchmark. That is what you plan for. The replacement rate is one of the most widely repeated figures in retirement planning and one of the most quietly misleading because it is a statistical average derived from observing what retirees actually spend, and a meaningful portion of those retirees were spending less than they wanted because they had no choice, not because they had found some sustainable, deliberate equilibrium. The 70 to 80% figure originated from studies of actual retiree spending patterns across wealth levels, including retirees who were constrained by insufficient savings rather than liberated by thoughtful planning. Using their observed behavior as a planning target is a circular error, measuring how much people spent because they ran short and then recommending that number as what you should aim to spend. A 2018 study by the Employee Benefit Research Institute found that retiree spending patterns are highly variable. Some households experience significant expenditure increases in early retirement, while others decrease sharply, and no single percentage accurately captures the range across different lifestyles, health situations, and geographic contexts. The replacement rate completely ignores healthcare costs as a separate, age-increasing line item. For many households, healthcare spending in retirement rivals or exceeds working year levels even after Medicare, which the 80% figure absorbs without acknowledging. Tax efficiency planning also shifts the calculation significantly. A household drawing from Roth accounts, harvesting capital gains at favorable rates, and managing distributions across account types may need a higher or lower gross income to achieve the same after-tax spending. A dimension the replacement rate entirely ignores. Travel, gifting, and family support costs in early active retirement frequently push real spending well above 100% of pre-retirement income. The 80% rule gives you a comfortable sounding target. It does not give you a plan. Use it as a starting point, never as a finish line. 32. Bonds are the safe part of your portfolio, predictable, stable. When stocks decline, bonds provide the ballast. That is the entire structural rationale for holding them. 2022 provided one of the most instructive reminders in recent financial history that safe is not the same word as stable, and that the assumptions embedded in just hold bonds had been quietly building toward a breaking point for years before they broke all at once. The United States aggregate bond index declined approximately 13% in 2022, the worst single-year performance in the modern era of bond market history. Long-duration bonds fell more than 25%. Retirees holding bonds as their safety allocation experienced losses in the asset class they believe was their protection, At the same time, the equity portion of their portfolio was also declining. The inverse relationship between interest rates and bond prices is not complicated in principle. When rates rise, existing bond prices fall. The Federal Reserve raised rates from near zero to over 5% in approximately 18 months between 2022 and 2023, producing exactly the bond price decline the math had always predicted would follow that kind of rate movement. Bond duration, the measure of a bond's sensitivity to interest rate changes, determines the magnitude of price impact. A 20-year Treasury bond with a duration of approximately 18 drops roughly 18% in price for every 1% rise in interest rates. The 60/40 portfolio failed to provide its intended diversification benefit in 2022 because both stocks and bonds fell simultaneously, a correlation breakdown that historically occurs during inflationary environments. Short-duration bonds, Treasury inflation-protected securities, and Series 1 savings bonds provide meaningfully different risk profiles than long-duration instruments, distinctions that blanket bond recommendations consistently fail to specify. Calling bonds safe without specifying duration, quality, and rate environment is like calling driving safe without specifying the road, the car, or the speed. 2022 was the reminder that the label and the experience are not always the same thing. 33. Once you retire, the Roth IRA chapter is closed. Your income dropped. That was for your working years. The contribution window is behind you. This assumption cost retirees significant tax savings across retirement. Not through dramatic errors, but through the quiet failure to use one of the most flexible and structurally superior tools available during the years when it would do the most good. A Roth IRA carries no required minimum distributions during the account owner's lifetime, making it the most flexible asset in an entire retirement portfolio. It compounds tax-free indefinitely, provides income that does not trigger the Social Security taxability threshold, and does not contribute to the modified adjusted gross income calculation that determines Medicare IRMAA surcharges on Part B and Part D premiums. The years between retirement and required minimum distribution commencement, typically spanning ages 65 to 73, frequently represent a tax planning window where income is lower than during peak earning years and lower than it will be once RMDs begin. Roth conversions executed during this window can reduce lifetime tax burden significantly by shifting assets from tax-deferred to tax-free status at the lowest rates available across an entire working and retirement career. Bracket harvesting, deliberately converting just enough traditional IRA assets to Roth each year to fill available lower tax brackets without crossing into the next, is among the most consistently cited strategies by fee-only financial planners for reducing total lifetime taxes paid. Part-time earned income in retirement creates Roth IRA contribution eligibility. A retiree earning $7,000 through consulting can contribute up to the full annual limit, $7,000 in 2024 for those 50 and older, building tax-free assets even after leaving formal employment. Roth assets inherited by non-spouse beneficiaries must be distributed within 10 years under current Post-Secure Act rules, but do so entirely tax-free, making Roth the superior intergenerational transfer vehicle for beneficiaries in meaningful income tax brackets. Stopping your Roth strategy at retirement because you are done saving is like stopping exercise once you get healthy. The work you continue is what keeps everything working. 34. Cybersecurity is a young person's problem. You are not doing anything complicated online. You are not a target. This belief is not only wrong, it is the specific belief that makes you a better target. Retirees are disproportionately pursued by financial fraud precisely because they are perceived to have accumulated savings, follow predictable daily routines, and exercise lower digital vigilance than younger demographics. The financial losses are substantial, frequently total, and in most cases entirely unrecoverable within a retirement timeline. The FBI's Internet Crime Complaint Center reported that Americans over 60 lost more than $3.4 billion to cybercrime in 2023. a tenfold increase over a decade and a figure that exceeds losses reported by every other age group. Investment fraud, tech support scams, romance scams, and grandparent scams are the top 4 categories targeting older Americans. All 4 are engineered to build trust over time, circumvent rational evaluation through manufactured urgency, and prevent the target from consulting family members or financial advisors before the money moves. Cryptocurrency fraud targeting retirees, documented by the FBI under the term pig butchering, involves cultivating trust over weeks or months before directing victims to fraudulent investment platforms that display fabricated returns until the funds are withdrawn and disappear. Social Security Administration impersonation scams in which callers claim the victim's social security number has been compromised or suspended generated hundreds of millions in losses to retirees who provided personal and financial information under manufactured fear of immediate legal consequences. Strong unique passwords, 2-factor authentication on financial accounts, and regular account monitoring reduce fraud risks substantially, but adoption rates among older Americans remain lower than other age groups. The irreversibility of retirement savings losses makes fraud uniquely damaging compared to losses at any other life stage. A 70-year-old who loses $200,000 to a scam cannot recover it by returning to work for a few years. The money and the time to replace it are both gone simultaneously. Not worrying about cybersecurity because you are not a target is exactly why you are a target. 35. Retirement is either paradise or a void. Endless freedom or crushing boredom. Everyone has a strong opinion, almost everyone repeats it confidently, and almost no one is prepared for the psychological reality of what actually happens in the transition. Neither the paradise narrative nor the boredom narrative equips you to navigate what researchers have documented as a predictable and largely universal adjustment curve, and walking into that curve without preparation produces a specific kind of distress that financial planning alone cannot address. Robert Atchley's continuity theory of retirement describes a common trajectory. Initial euphoria during what researchers call the honeymoon phase, followed by disenchantment or disorientation, followed by reorientation, and eventually a stable routine that resembles intentional living rather than extended vacation. Many people experience the middle phase with genuine surprise and distress because nothing in the retirement planning conversation warned them it was coming. Identity disruption is the most underestimated psychological challenge in the entire retirement transition. For many professionals, the answer to "what do you do" was their primary self-definition for 40 years. Retirement removes that answer without automatically supplying another, and the absence is more disorienting than most people anticipate. A study published in the Journal of Population Aging found that 25 to 30% of recent retirees experience what researchers describe as post-retirement depression, characterized by loss of purpose, reduced social engagement, and diminished sense of competence. The activities that feel appealing in anticipation of retirement, travel, golf, unscheduled leisure, frequently lose their appeal when they are no longer a contrast to work, but simply the entire structure of every single day. Couples who retire simultaneously face relationship dynamics that neither partner typically anticipates, with research showing elevated stress during the adjustment period, particularly when one partner is significantly more socially active outside the home. Preparing for retirement financially but not psychologically is like training your entire life for a marathon and then not knowing what to do with your legs once the race ends. The finish line is not the destination, it is the beginning of the harder question. 36. You don't have complicated investments, no business, no inheritance. Simple situation. You don't need formal financial planning. Simplicity of assets is not the same as simplicity of retirement planning. And the core questions that determine whether a retirement succeeds or fails apply with equal force to a $400,000 portfolio and a $4 million one. The variables that matter most in retirement are not primarily about asset complexity. They are about withdrawal sequencing, tax management, social security optimization, healthcare planning, and longevity risk, all of which require modeling regardless of how straightforward your balance sheet appears. Social security optimization alone determining the right claiming age, coordinating spousal benefits, and modeling break-even under different longevity scenarios can produce lifetime value differences of $50,000 to $100,000 or more. This is not a complex asset question. It is a benefits optimization question that applies to everyone who has ever paid into the system. Tax bracket management in retirement, deciding how much to withdraw from tax-deferred versus Roth accounts each year to minimize lifetime tax burden, requires analysis that is equally relevant for a $400,000 traditional IRA as for a much larger one. Medicare enrollment decisions, which parts, which supplements, which Advantage plans evaluated against income, health status, and physician preferences, are genuinely complex decisions that most retirees navigate without professional guidance, consistently producing suboptimal coverage and unnecessary annual cost. Required minimum distribution management, Roth conversion opportunities, qualified charitable distribution strategies, all of these apply to anyone with a meaningful traditional retirement account balance, regardless of overall wealth. The assumption that formal planning is only for wealthy or complex situations is a perception problem partially manufactured by an industry that markets primarily to high net worth clients. Fee-only financial planners who charge hourly rates are accessible at any asset level. Not needing a retirement plan because your finances are simple is like not needing a map because you are only driving across town. The destination is still specific, the road still has turns, 37 tax laws will change, Social Security will be cut, Medicare will be restructured. Planning is pointless when the government can simply change every rule you built your plan around. Policy risk is real, worth acknowledging, and worth building flexibility to address. But using it as a reason to avoid planning is the retirement equivalent of not buying insurance because you have heard that insurance companies sometimes deny claims. The reasoning defeats the purpose it is trying to serve. Tax law changes are genuinely cyclical, but the direction of change is not random or uniformly harmful. The most consistent long-term risk is higher future tax rates, a risk specifically mitigated by Roth conversion strategies executed while current rates are known and controllable. Planning for tax risk requires action, not paralysis. Social Security has been modified numerous times since 1935. Benefit formulas, taxability thresholds, full retirement ages, and cost of living adjustment calculations have all been adjusted over the decades. But benefits have never been eliminated, and cuts to existing beneficiaries have historically been rare and modest in scope. Projecting zero Social Security income in your plan is as unrealistic as projecting full, unchanged benefits. A probability-weighted scenario across the realistic range of outcomes is more analytically sound than either extreme. The Secure Act, Secure 2.0, and related recent legislation changed retirement planning significantly, but the direction of change has generally expanded available options. Higher contribution limits, later required minimum distribution ages, new account types, rather than restricting them. Political risk scenario planning, modeling your retirement across a range of plausible Social Security benefit reductions, is a legitimate and productive exercise. Most people find the range of realistic scenarios is manageable with adequate savings and spending flexibility. Geographic optionality, the ability to relocate across state lines in response to tax or benefit changes, represents a legitimate hedge for retirees whose mobility exceeds that of working-age households. The rules might change as a reason to build flexibility into your plan. It is not a reason to skip the plan entirely. 38, you've saved enough. You don't need to track every dollar in retirement. That's the whole point of saving enough. To stop stressing about money. The absence of a retirement budget is not freedom. It is a precision instrument for not knowing when your plan is drifting off course until it has drifted far enough that course correction is painful or impossible. Portfolio depletion rarely announces itself with dramatic clarity. It arrives through a decade of withdrawals, running slightly higher than projected, returns landing slightly below assumptions, and healthcare costs exceeding estimates, none of which register as a crisis in any individual year, but which compound into a serious shortfall that is only visible if someone is measuring against a baseline. Research by T. Rowe Price found that retirees who regularly reviewed their spending against their financial plan maintained higher portfolio survival rates than those who did not, specifically because they made small adjustments early, before problems became structurally irreversible. Enough is a moving target that the original plan cannot track without active monitoring. A portfolio sufficient at 65 may be materially insufficient at 72 if healthcare costs spiked unexpectedly, market returns disappointed in the early years, or an adult child needed financial support that was provided without updating the underlying projections. The highest risk retirement failure mode is not sudden poverty. It is gradual, invisible depletion, spending 5 to 10% above a sustainable rate for years, because there is no feedback mechanism in place to identify the gap until the portfolio is dangerously reduced. Tax drag is similarly invisible without active tracking. A retiree drawing too heavily from tax-deferred accounts in early retirement may generate RMD obligations in later years that a budget would have helped structure around. Modern retirement tracking tools are not about deprivation, they are about visibility, knowing your actual withdrawal rate, identifying adjustments that would extend the plan's longevity, and confirming that current behavior matches the assumptions you've built everything else around. Not budgeting because you have enough is like ignoring your fuel gauge because you started with a full tank. 39, as you get older, you see fewer people. The social circle shrinks. You slow down. It is natural. This framing converts a modifiable risk factor into an inevitable feature of aging. And in doing so, it removes the motivation to address something that has measurable, documented consequences for how long you live and how well your brain functions while you do. Social isolation in retirement is not a natural inevitability, it is a health risk with the same clinical standing as the ones your doctor tracks at your annual physical. The United States Surgeon General issued a formal advisory in 2023 declaring loneliness and social isolation a public health epidemic, noting that the health impact of poor social connection is equivalent to smoking 15 cigarettes per day and significantly exceeds the health risk of obesity as measured against mortality outcomes. A meta-analysis of 148 studies by Holt, Lundstad, and colleagues found that social connection increased survival odds by 50%, a stronger predictor of longevity than physical activity, dietary quality, or absence of air pollution exposure. Retirement eliminates the workplace's structural social contribution without automatically replacing it. Daily interaction with colleagues, shared purpose, casual conversation, all of it disappears on a specific date without a substitute unless one is deliberately built. Without intentional replacement, social contact declines rapidly in the early retirement years, often faster than the retiree perceives from the inside. The Rush Memory and Aging Project found that socially isolated older adults experienced cognitive decline at rates nearly double those of socially engaged peers, independent of other health factors. Physical health consequences of chronic loneliness include elevated cortisol, increased inflammatory markers, higher blood pressure, and disrupted sleep, all of which contribute to cardiovascular disease and earlier mortality. Community engagement, volunteer activity, and deliberately scheduled social contact are evidence-supported interventions. Social isolation does not just happen, it is built gradually by an absence of intention, which means it can be prevented by exactly the opposite. 40. You have managed your own money for 40 years. You will manage it until the end. You do not need anyone else involved. Financial decision-making capacity declines measurably with age, often before the individual experiencing the decline is aware it is happening. And the absence of any trusted oversight structure creates serious exposure to both honest mistakes and deliberate financial exploitation at exactly the stage of life when the losses are least recoverable. Research by David Laibson at Harvard found that financial decision-making ability peaks at approximately age 53 and declines measurably thereafter. This is not dementia. It is a normal age-related reduction in the processing speed and executive function that affects complex financial decisions before it affects the activities of daily life, meaning the decline is frequently invisible to the person experiencing it. Financial exploitation of older adults by strangers and more commonly by trusted family members or caregivers is estimated to cost Americans over approximately $28 billion annually per a 2015 TrueLink financial report. The typical window between the onset of cognitive impairment and formal diagnosis is 3 to 5 years. During that period, financial decisions, yet often large and irreversible, may be made with meaningfully impaired judgment while appearing outwardly normal to family members not paying close attention. Approximately 1/3 of adults 85 and older have Alzheimer's disease, according to the Alzheimer's Association. Establishing a trusted oversight structure, a durable financial power of attorney, a co-trustee on a revocable trust, a trusted contact person on investment accounts, annual plan reviews with a family member, does not remove your autonomy. It provides a circuit breaker for the period when autonomous decision-making becomes unreliable without your consent being the mechanism that enables it. The Consumer Financial Protection Bureau has published specific guidance on trusted contact persons for financial accounts as a federally recognized protection mechanism. Planning to manage your own finances indefinitely without any oversight structure is not independence. It is a plan that works perfectly until it doesn't. And the moment it stops working is precisely when you are least equipped to notice. 41. Your parents have savings in a house. There will be an inheritance. That will supplement your retirement when the time comes. The great wealth transfer is real in aggregate. Trillions of dollars are projected to move between generations in the coming decades. Whether a meaningful portion of it arrives in your personal retirement account at a useful time in the amount you are imagining is considerably more uncertain than the headline figures suggest. Healthcare and long-term care costs in the final years of a parent's life frequently consume a substantial portion of the estate that was expected to be transferred. A single extended nursing home stay at $108,000 per year can deplete a $500,000 estate in 4 to 5 years before any other end-of-life expenses are accounted for. Americans are also living longer, meaning the average inheritance arrives later in the recipient's life than it once did. If your parents live to 90, you may receive an inheritance at 65. Potentially, after the financial decisions that most significantly shape your retirement security have already been made and cannot be revisited. Divorce, remarriage, business setbacks, medical emergencies, and spending patterns that diverge from conservative assumptions are among the factors that regularly reduce expected inheritances without any notification to the people doing the expecting. Estate planning attorneys consistently observe the gap between what adult children anticipate receiving and what is actually available, noting that the gap is rarely the result of secrecy. It is usually the result of costs no one planned for adequately. The Federal Reserve Bank of St. Louis research found that the median United States inheritance is approximately $58,000, meaningful as a supplement but not retirement sustaining as a foundation. Planning your retirement around an expected inheritance is building a plan on a number that belongs to someone else, depends on circumstances you cannot see, and arrives on a timeline that is not yours to control. It is not a plan. It is a wish with a beneficiary designation attached. 42. Take the lump sum. You control the money. You can invest it better than the pension fund. Flexibility is the whole point. The blanket instruction to always take the lump sum over the pension is one of the more confidently delivered pieces of financial advice that is most specifically wrong for the specific person receiving it. Because the decision is actuarial, individual, and permanent, and the always take the lump sum position ignores math that the pension fund has already calculated on its own behalf, not yours. Pension funds calculate lump sum offers using actuarial tables and IRS segment rates. When interest rates are high, lump sum values are mathematically lower. The 2022 rate increases produce material reductions in lump sum values that cost some workers tens of thousands of dollars by waiting past the optimal window. A direct demonstration that the timing of a lump sum decision carries its own significant financial risk. The internal rate of return embedded in a lifetime pension annuity, the return you would need from a lump sum investment to replicate the guaranteed lifetime income, frequently falls between 4 and 6% in real terms, which is not a trivially achievable target in fixed income across a long retirement. A pension provides guaranteed, non-market correlated income whose behavioral value, allowing the equity portion of your portfolio to weather volatility without triggering panic selling, is measurable and documented in the research on sustainable retirement income. The "I will invest it better" assumption collides with the Dahl-Bar, finding that most individual investors significantly underperform the market over time. Beating a guaranteed equivalent return of 5% through individual investing is not the expected outcome, it is the optimistic scenario. Survivor benefits on pension income, which reduce the monthly payment but continue it for a surviving spouse, carry genuine insurance value that a lump sum does not replicate without separately purchasing annuities. A healthy 62-year-old with family longevity should model the break-even age carefully. Always take the lump sum as advice written for a hypothetical investor who beats the market, lives exactly as long as average, and has no spouse. Check whether that describes you before making an irrevocable decision. 43. You budget for healthcare. You know the premiums. You accounted for the deductibles. Healthcare in retirement is under control. Healthcare costs in retirement are among the least predictable line items in any retirement budget, driven by utilization patterns that are inherently uncertain, policy changes that are externally controlled, and longevity that is biologically unpredictable in ways that compound across every variable simultaneously. The Milliman Medical Index, which tracks employer-sponsored healthcare costs, has risen at an average annual rate of approximately 6 to 7% over the past 2 decades, significantly above general inflation, with no historical basis for assuming the trend decelerates meaningfully in retirement. Medicare Advantage plans, which now cover more than half of all Medicare enrollees, can change their provider networks, drug formularies, and benefit structures on an annual basis. A medication covered at minimal cost this year may be tiered expensively or dropped from the formulary next year with no recourse available to the enrollee mid-plan year. Out-of-pocket liability under original Medicare, absent a Medigap supplemental policy, carries no annual maximum. A prolonged hospitalization or complex illness produces personal financial exposure with no ceiling. Prescription drug costs for specialty medications treating cancer, rheumatoid arthritis, or multiple sclerosis can reach $10,000 to $50,000 annually before insurance. The Inflation Reduction Act's $2,000 annual out-of-pocket cap on Part D drug costs, effective in 2025, provides genuine relief in this category. But specialty drug access under Medicare remains subject to formulary negotiation that changes year to year. Dental, vision, and hearing costs, excluded from traditional Medicare, are unpredictable in timing and magnitude by nature. A single dental event involving implants, crowns, or bridges can produce costs of $10,000 to $30,000 on relatively short notice. Budgeting for healthcare in retirement by projecting current costs forward in a straight line assumes that tomorrow looks like today. Sometimes it does. Then comes the thing no one budgeted for, and the straight line bends. 44. Once you retire, your risk tolerance drops to 0. You are done accumulating. Now you protect. Risk is for younger people. You cannot afford to lose anything at this stage. Risk tolerance and risk capacity are 2 entirely different measurements, and conflating them in retirement produces decisions that feel psychologically sound and are financially corrosive over a long enough timeline to matter. Risk tolerance is psychological. How volatility feels when you are watching your account balance move. Risk capacity is mathematical. How much volatility the portfolio can absorb given your withdrawal rate, your income sources, and your remaining time horizon. These 2 measures frequently point in opposite directions in retirement, and the one that protects your financial future is not the one that makes the quarterly statement easier to read. A retiree with 30 or more years ahead, a diversified portfolio, stable Social Security and pension income, and a 2-year cash buffer has significant risk capacity, even if their emotional tolerance for seeing a declining balance is genuinely low. A portfolio of 100% bonds or cash equivalents in real inflation-adjusted terms is guaranteed to lose purchasing power across 3 decades, making it not conservative, but simply a different kind of risk wearing a more comfortable label. Research by Michael Kitches demonstrates that a rising equity glide path in retirement, actually increasing equity exposure modestly in the early years, can produce better long-term outcomes than the traditional declining equity approach that most people follow by reflex. The liability matching approach, holding assets specifically matched to projected income needs by time period, allows appropriate equity exposure in long horizon buckets without subjecting near-term spending to market fluctuations. Vanguard research on behavioral coaching quantifies the value of preventing panic selling during market corrections at approximately 1.5% annually, larger than the value of any specific investment selection. The risk is not the market. The risk is your response to the market. Eliminating equities to avoid volatility trades one risk for a slower, quieter, and equally real one. 45. You've told your kids what's coming. No surprises, no fighting. Transparency is the right approach. Discussing general intentions with your family is wise and frequently neglected. Disclosing specific dollar amounts and precise distribution arrangements in detail years before they become relevant is a reliable way to create family dysfunction that plays out while everyone is still alive, and often in ways that damage the relationships that disclosure was intended to protect. Research in behavioral economics shows that anticipated windfalls alter savings behavior, career decisions, and relationship dynamics in measurable ways that are frequently negative. Adult children who know a large inheritance is coming save meaningfully less for their own retirement, making the anticipated transfer functionally counterproductive to the financial independence of the generation receiving it. Estate planning attorneys and family therapists consistently report that unequal distributions disclosed in advance, even distributions with entirely legitimate rationale, such as one child serving as primary caregiver or one child having already received significant lifetime gifts, produce prolonged family conflicts that damage relationships years before anyone has passed. Communicating the existence and general nature of an estate plan, the location of key documents, the identity of the executor, the existence of a trust, is unambiguously valuable and frequently neglected in favor of either total secrecy or total disclosure. Communicating precise financial figures is a different conversation carrying a different risk profile that varies significantly by family dynamics. Beneficiary designations on retirement accounts, life insurance policies, and transfer on death accounts supersede wills entirely and are frequently unknown to beneficiaries, creating unnecessary delays and occasional legal challenges when accounts are misdirected because no one knew they existed. The conversation about healthcare directives, powers of attorney, and end-of-life preferences is vastly more important than the conversation about asset amounts, and vastly more consistently avoided. Telling your children exactly what they are inheriting years in advance is not always clarity. Sometimes it is a preview that changes how people act around you, and not always in the direction you were hoping for. 46. You worked with a financial planner, built a retirement plan, and now you are set. The plan is done. A retirement financial plan is not a document you produce once and file in a drawer. It is a living process that requires regular calibration against changing market conditions, evolving tax law, shifting health status, new family circumstances, and personal priorities that will change in ways you cannot fully anticipate at the starting point. Any one of these variables can fundamentally alter the assumptions the original plan was built on, and several of them will change simultaneously. The Secure Act of 2019 and Secure 2.0 of 2022 changed required minimum distribution ages, inherited IRA distribution rules, catch-up contribution structures, and Roth employer plan access, all requiring plan revisions for millions of retirees and pre-retirees. A plan written in 2018 was technically obsolete by 2020. Tax law changes, particularly the potential sunset of Tax Cuts and Jobs Act individual provisions after 2025, create planning uncertainty that requires scenario analysis rather than fixed projections built on rates that may not survive the next congressional session. Market returns in the first 5 to 10 years of retirement determine sequence of returns outcomes that average return assumptions in the original plan cannot capture. A real-time review following a significant market event that adjusts withdrawal rates accordingly can extend portfolio survival by years. Health events, a major diagnosis, a spouse's cognitive decline, a change in functional ability, regularly require fundamental revision across housing, insurance, care cost projections, and Social Security timing decisions that the original plan assumed would unfold differently. Family changes, a child's financial crisis, an unplanned educational expense, an adult child's divorce, produce unplanned financial transfers that alter the plan's assumptions without a formal review capturing them. The standard recommendation is annual comprehensive review with full reassessment every 3 to 5 years or after any major life event. Treating a retirement plan as a finished product is like setting your navigation at the start of a trip and then ignoring it entirely when the road you planned on closes 200 miles in. 47, your parents have a house and savings. There will be an inheritance. This is covered under item 41, so let's use this slot to address the myth that business partnership retirement planning takes care of itself. You and your partner built this together. When the time comes, you will sell it or hand it off together. It is a joint retirement. Solid. Business partnership retirement planning is among the most complex and most frequently mishandled succession scenarios in personal finance, because it requires two people's timelines, valuations, and life events to align with a precision that real life reliably refuses to deliver. The death, disability, or early retirement of one business partner without a formal buy-sell agreement in place is one of the most financially disruptive events in small business ownership. Without legally documented valuation methodology and a funded execution mechanism, the surviving partner may find themselves in an involuntary partnership with the deceased partner's estate or heirs, a situation that is expensive, disruptive, and entirely avoidable. Buy-sell agreements require a pre-agreed, legally binding valuation method and a funding mechanism, typically life insurance or disability insurance, to ensure the buying partner has actual liquidity to execute the purchase when it becomes necessary rather than theoretical. Differing retirement timelines between partners create structural tension that destroys both businesses and relationships when not addressed in advance. The partner who wants to exit at 62 is asking the remaining partner to fund a buyout while simultaneously absorbing the operational gap, a demand that rarely goes smoothly without years of advanced structuring. Business valuations for closely held companies are not objective transactions. The range of defensible valuations for the same business by different qualified appraisers can vary by 30 to 50%, which means pre-agreeing on methodology is not a formality. It is the substance of the agreement. Tax treatment of a business sale can produce after-tax proceeds that differ by hundreds of thousands of dollars depending on structure. Succession planning that begins 5 to 10 years before the exit produces dramatically better outcomes than planning that begins at the moment of intended departure. A buy-sell agreement you never got around to drafting is not a plan. It is a lawsuit in waiting. 48. Save enough, invest correctly, choose the right accounts, retire on schedule, and then relax. Follow all the rules and retirement will take care of itself. The rules are necessary, they are not sufficient. Retirement success is ultimately not a function of perfect execution of financial rules alone. It is a function of building a life that remains purposeful, connected, and adaptable across multiple decades that will surprise you in ways the rules were never designed to address. The financial planning literature consistently identifies behavioral factors, maintaining discipline during market downturns, avoiding lifestyle inflation, staying committed to a withdrawal strategy, as more predictive of retirement success than any specific investment selection. The behavior is harder than the math, and no rule automates it. Longevity is the variable that no rule fully tames. A plan built for a 30-year retirement that runs to 35 years has not failed in its execution. It has encountered a good problem that requires ongoing adaptation the original rules did not anticipate. Psychological research on retirement satisfaction identifies 3 non-financial factors as the strongest predictors of subjective well-being in retirement: maintaining social connections, having purposeful activities, and exercising meaningful autonomy over daily time. None of these appear in a financial plan. The rules are written for an average American life trajectory: divorce, serious illness, extended caregiving responsibilities, business failures, family crises, and economic disruptions fall outside the rules and require flexibility, resilience, and willingness to revise the plan rather than abandon it. Every projection in a financial plan is a model. Every model is wrong in specific ways that only become visible over time. The value of a retirement plan is not its accuracy across 30 years. It is the monitoring process and the adjustment capacity it makes possible when reality diverges from projection. The retirees who report the highest life satisfaction in the research are not uniformly those who executed the rules most precisely. They are the ones who remained curious, engaged, and willing to build a new version of themselves after the career chapter closed. The math keeps you solvent. The life keeps you alive in the way that matters. 49. Financial planning is only for wealthy or complicated situations. Your situation is simple, so formal planning is unnecessary. The core retirement planning questions: withdrawal sequencing, tax management, healthcare coordination, social security optimization, and longevity risk apply equally and with the same consequence to a modest portfolio as to a large one. The financial outcomes of getting these decisions right or wrong do not scale down proportionally just because the account balance is smaller. Social security optimization alone, the right claiming age, spousal benefit coordination, break-even analysis across longevity scenarios, can produce lifetime value differences of $50,000 to $100,000 or more for households at any income level. This is not a wealthy person's question. It is a universal question with a universal financial impact that varies based on the decision made, not the size of the account. Tax bracket management in retirement: how much to draw from tax-deferred versus Roth accounts annually to minimize lifetime taxes paid, applies to any meaningful traditional IRA balance and requires the same analysis at $400,000 as at $4 million. Medicare enrollment decisions involve genuine complexity regardless of income. Which parts, which supplements, which Medicare Advantage plans, evaluated against specific health conditions, preferred physicians, and prescription drug needs, consistently produce suboptimal and unnecessary costs when navigated without informed review. Required minimum distribution management, Roth conversion opportunities, and qualified charitable distribution strategies apply to anyone with a traditional retirement account and produce tax savings that are proportionally significant regardless of account size. The assumption that formal planning is only for complex situations is a perception problem partially manufactured by an industry that markets most visibly to high net worth clients. Fee-only planners who charge hourly rates are available at any asset level and provide the same category of analytical value at any balance. Not needing a plan because your finances are simple is like not needing a map because the trip is short. The destination is still specific. Getting lost on a short trip is still getting lost. 50. Do everything right, save enough, invest correctly, choose the right accounts, retire on schedule, and then relax. This is a restatement of the rules are sufficient myth from a different angle. Because the version of this myth that deserves its own treatment is the specific belief that a correct financial plan protects you against the policy and regulatory changes that could alter its assumptions. Tax laws will change. Required minimum distribution rules have already changed twice in recent years. Social Security's long-term funding status is a documented actuarial concern. Medicare's benefit structure evolves under political and budgetary pressure. A retirement plan that treats current policy as permanently fixed is building on ground that moves. The resolution is not to assume catastrophe and stop planning. It is to build flexibility into the plan, specifically to accommodate a realistic range of policy outcomes rather than a single projected scenario. Roth conversions executed at current known rates protect against the risk of higher future tax rates. Social Security planning that models a range of benefit scenarios from full projected benefits to a 17% reduction under current trust fund depletion projections produces a plan that is robust across outcomes rather than fragile against a single assumption. Geographic optionality, the ability to relocate in response to state tax or benefit changes, represents a hedge available to retirees with more mobility than working-age households. Annual plan reviews that incorporate legislative changes as they occur prevent the compounding divergence between a static plan and a dynamic regulatory environment. The Secure Act and Secure 2.0 both changed the retirement planning landscape significantly, but both also expanded available options for most people rather than restricting them, suggesting that policy change is not uniformly adversarial to retirement savers. Building flexibility into your plan because the rules might change is the correct response to genuine uncertainty. Abandoning planning because the rules might change is choosing certain unpreparedness over manageable uncertainty. One of those is a strategy. The other is an excuse. 51. Follow all the rules and retirement will take care of itself. Save enough. Invest correctly, choose the right accounts, retire on schedule, then relax. The rules are necessary, they are not sufficient, and treating them as sufficient is the final myth, the one that wraps all the others into a single false sense of completion. Financial planning is a necessary floor for a functional retirement. It is not a ceiling, and it is not a replacement for the harder, less quantifiable work of building a life with enough purpose, connection, and adaptability to sustain you across 3 decades that will not look like anything you planned for in detail. The financial planning literature consistently identifies behavioral factors: staying invested during downturns, avoiding lifestyle inflation, maintaining a withdrawal discipline through volatility, as more predictive of retirement success than specific investment selections. The behavior is harder than the math, and no rule automates the behavior for you. Every projection in a retirement plan is a model. Every model diverges from reality on a specific timeline. The value of the plan is the process of monitoring, adjusting, and recalibrating it when reality departs from the projection, which it will repeatedly across 30 years. Divorce, illness, caregiving, economic disruptions, and family crises do not appear in the rules, and the rules provide no instruction for navigating them. Longevity is the variable that no plan fully tames. A 30-year plan that runs to 35 years has not failed. It has encountered a good problem that requires continued attention the original document cannot provide. Research on retirement satisfaction consistently finds that the highest reported well-being belongs not to those who executed the financial rules most precisely, but to those who remained curious, socially connected, and willing to construct a new version of themselves after the career chapter ended. The math keeps you solvent. The life keeps you alive in the way that actually matters. Both require sustained attention. Neither runs on autopilot, and neither one forgives you for assuming the other one covers it. If you want to see more, click the video on screen now.